program. And what we're really quickly going to talk about is how to profit in the red market. So this is going to be a really good video for traders and also sometimes long-term investors that don't really understand what to do in an event where the market is not always green. And what I mean by the market not always being green is that the market is not always going up. And what we've seen pretty much this past month, I want to say the past 30 days to be accurate, is that we've seen a lot of volatility in the market. We also seen the market a lot of times going down. So what we're seeing and what we saw today is that the market started off red, and then for the Dow and the S&P, it recovered and eventually closed green. However, for the NASDAQ, it still closed red. And many times, if you're following a lot of other people on YouTube that are giving you market-based education, their solution or their counsel in this particular time period is that you should just keep buying stock. So their rationale was that it doesn't matter if the market is green or the market is red, you should just continue to keep buying. And that works if you don't know what to do when the market is going down. And one of the challenges I have is this, and we're going to kind of get into some analysis of a share price movement. So I want you to understand something. Over the course of a year, let's say 52 weeks, right? You have something called a 52-week high and a 52-week low on the share price. So let's say, hypothetically, we're looking at company ABC. Let's say their 52-week high is $100. Let's say their 52-week low is $40, right? So that's the high and the low over that 52-week period. So then the market opens up, and it was at that 52-week high, the market opens up and it starts to sell off, right? And then over the course of, let's say, the next 3 to 4 days, it now lands at around $70. What a lot of times these pundits will tell you is that they will explain to you that this particular share price is at a discount. And in their mind, because it's at a discount, what you should do is continue to buy. Well, I want you to understand something. You got it when you're looking at a stock price over a 52-week period. You can't just look at the high. You also got to look at the low. So I want you to look at it from this perspective. If a company was trading and its low point was $40 and it moved up off $40 and it got to 100, and then when it got to 100, it started to sell off and started to continue to go down. And when you looked at it again, it was at 70. The question I want to ask you is that, why do you think it sold off that 52-week high? And if you don't know why it sold off the 52-week high, well, then buying it at 70 is not necessarily the best thing to do, because how do we know that it can support $70? And so there's a reason why when a company goes and it hits a particular, what we call a resistance point, and it starts to sell off, is because the market doesn't believe it can justify that price point. So you'll see companies a lot of times hit price points and sell off real hard because the market is not comfortable with it at that price point. Nobody believes it's really worth that. And you got to understand is that the market, a lot of times, their understanding of their analysis of a company is really based on emotion. It's really not based on sitting back and looking at like deep valuation of the company, the discounted cash flows, return on equity, return on capital. A lot of people don't even understand how to do that. They just have an emotional perception of what they think that company's worth. Therefore, thinking that a company is discounted just because it's off its 52-week high is not always a justification to buy the company. So what I want you to understand is that once you understand how to play the downside of the market, when a company hits its 52-week high and we're starting to see indications that it cannot support that price point, there's money to be made as it finds its new support and its new resistance on the way down as it starts to sell off. And you see that with a lot of these IPOs that have come out recently. They come out of the gate real hard. They run up real hard because of a lot of enthusiasm about that company. And then once they get to a certain point, they sell back off a lot of times just as fast as they ran up. And so when you understand how to play that and how to take advantage of it, you can make money on the upside, but you also can make money on the downside, right? And so what I want you to understand is that if all you've been taught how to do from the person that you're dealing with from a stock buying or a wealth building stock course is just to continue to buy the stock, even when it's selling off because it's quote unquote at a discount, without any analysis of why it's being sold off so rapidly at particular price points, in my opinion, you have an incomplete education about the market. And what I want to offer you is the opportunity to learn how to monetize the downside of a company, because people that have been around me understand that one thing I'm really, really good at is I understand how to make money in a red market. So when the market is red, that's when I make a lot of my money. In fact, I was telling people today on Facebook is that I think I've done one call contract on an options play since the first of the year. And I got stopped out of that because it was a Facebook call and it did go the way I wanted to go and it got stopped out. All my profitable plays in the market since the beginning of the year have all been put contracts. So since this market has been going down, I've just been doing put contracts because I understand, right, how to make money in a red market. So what I want you to really capture from this video, even if you choose not to deal with me, is that there's ways for you to make money when the market is going down. And the best situation for you to be in is not always to continue to buy regardless of the direction of the particular market or the particular company. Sometimes you need to analyze, why is this particular company selling off at this price? Where do we believe that this thing is going to stop and find some level of equilibrium? And maybe we need to wait and see where it settles as opposed to just buying more shares because it's quote unquote at a discount, right? That's kind of like the term that everybody uses when a company starts selling off. It's being discounted. But the question is, why is it being discounted? So if you go into a grocery store and you see that an item costs a certain amount of money, and then you come back next week and it's been marked down by 30%, the question is, why did it get marked down by 30%? How come it couldn't sell at the price in which they set originally, right? Is it because it's getting ready to expire? Is it because some bad information came out about this particular product? Is it because there's no demand for this product? Why is this thing being discounted or marked down at the original price to where now it's designed to try to influence you to buy it at this new price? And without asking yourself those kind of questions, I would really encourage you not to buy until you've answered some of those questions. So really quick video, really short, but I want to really tell you that if you want to understand how to monetize the downside of the market, that's something I'm extremely good at. And I'm probably better at the downside of the market as opposed to when the market's going up. And I'm really, I wouldn't say an expert, but I'm really efficient at organizing, at understanding downside scenarios and how to take advantage of them. So if you got any questions, hit me up in the comments, reach out to me. This is David W. Williams, also known as Diamond Dave, the founder of the highest paid part-time job in the world options trading program. And I'll talk to you later.